Good evening, everybody. Welcome back to this fourth day of the P4 question-based revision session. Um, we have had very good 3 days up till now, and okay, so we have had 3 days of sessions where what have we discussed up till now is we have gone through the risk management of the currency risk management. We have gone through the mergers and acquisitions area. So up till now, we have attempted various questions, and in those questions, we have tried to go through these specific areas. Now, today is the final session of this webinar, and I would try to ensure that I cover up different areas and I cover up various questions from the different areas. So that's what I would actually try to do. Let's actually start off. You people do have access to the handout that we have been using for this webinar. So if you could please refer to that specific handout again, because I'm gonna attempt the question from that specific handout only. Okay. So the first question that I would try to attempt today is basically this question of specimen exam of September 2018. The name of the question is basically Bureau Company. So I would try and attempt this specific question first. The name of the question is Bureau Company. Let's just start discussing about this Bureau Company, that what exactly is there in this Bureau Company. Let's discuss. Now, before I move on to this Bureau Company, I'm actually going to discuss the concept of adjusted present value. Okay, let's just start discussing about the concept of this adjusted present value. I'm going to give a brief background of what the adjusted present value is all about, and then we shall start attempting the question Bureau Company. So when we talk about the investment appraisal, so this investment appraisal, we study various techniques at the F9 level. But when it comes to this AFM P4 level, what actually happens is that there is an advanced stage technique, and that is actually termed as the adjusted present value. The advanced stage technique is actually termed as adjusted present value. Now, what exactly is this adjusted present value? So there are actually various limitations of NPV technique. There are various limitations of the NPV technique. Now, when I talk about the various limitations of the NPV technique, so basically what happens is the biggest limitations of the NPV technique is the use of weighted average cost of capital. Now, what are those limitations with respect to the use of weighted average cost of capital? So weighted average cost of capital is calculated like this: the cost of equity multiplied by market value of equity divided by market value of equity plus market value of debt, plus the cost of debt 1 minus t multiplied by market value of debt divided by market value of equity plus market value of debt. So this is how we calculate the weighted average cost of capital. When we apply the NPV technique, then what we do is that we use the weighted average cost of capital to discount the cash flows. I'm gonna explain few things that how do we actually handle this. What exactly is the limitation in using the WACC? The first of them is basically the market value of equity and the market value of the debt. The market value of equity and the market value of the debt, they keep on changing over a period of time. Let's say if there is a 4-year project, let's say year 1 till 4. So the market value of equity and the market value of the debt of the company would not remain constant during that time period. So if the market value of equity and market value of debt would not remain constant over a period of time, so what we are actually doing is we are actually discounting the cash flows using the WACC, which is calculated at time period 0. But the cash flow, but the WACC incorporates the equity and the debt value, which is not gonna remain same entire over the entire life of the project. So basically what happens is the changing value of equity, the changing value of the debt is not accounted for in this WACC. That's the number one limitation. The number two limitation is basically the tax rate could keep on changing. The cash flows that we use, the cash flows have a different tax rate. The cash flows have a different tax rate, but the WACC does not have a different tax rate. But the WACC tax rate is same. WACC tax rate is same. So that is another problem that actually arises. So I'm going to repeat again that the tax rate for the WACC is the same, which is the time period 0 tax rate. But in practicality, the tax rate could change for the various periods, and the cash flows for the various periods would be subject to different rate of tax. So that would also be a problem. And lastly, if we have a debt which is repayable over time, so what actually happens is that if the debt is repayable over time, so your overall cost of debt also changes. Your market value of the debt also changes. And unfortunately, when we use the weighted average cost of capital, we don't consider that changing level of debt, the changing level of cost of debt, etc., etc., etc. So in order to overcome these limitations of WACC, the APV technique is introduced. And when we talk about the APV technique, what is APV? The adjusted present value. Adjusted present value is basically base case NPV. Adjusted present value is base case NPV plus present value of financing side effects plus present value of financing side effects. So when we talk about the APV, it's actually the base case NPV plus the present value of the financing side effects. Now, what is this base case NPV? What is the present value of financing side effect? Let's discuss. The base case NPV actually means the NPV calculated on the assumption. Base case NPV actually means the NPV calculated on the assumption that entity is 100% equity funded. That is, the entity is 100% equity funded. I'm repeating it again. When we talk about the calculation of the APV, so the APV is calculated this way that we assume the APV means base case NPV, which is the NPV calculated on the assumption that the entity is 100% equity funded. Okay, so when we talk about this NPV, it's the NPV calculated on the assumption that the entity is 100% equity funded. Now, what next is that? Then when we talk about this present value of financing side effects, so let's discuss. this is another area which is the present value of financing side effects, which I'm actually going to discuss in a while. First of all, let's discuss that when we talk about the NPV calculated on the assumption that the entity is 100% equity funded. So what do we mean by this? There are actually two ways of dealing this scenario. There are actually two ways of dealing this scenario. One of the ways is the use of MM2. One of the ways is the use of MM2. Now, you may ask a question that what exactly do you mean by using MM2? So I'm going to give you an idea that how do we use MM2 to it. If you go to this exam paper, you would find that the formula sheet of the examination, it contains this MM2 formula. So I'm going to discuss this MM2 formula right now, so that you people can have a better idea that how do we actually apply the MM2 formula. So the first thing is the adjusted present value is calculated on the assumption that the entity is 100% equity funded. Okay, now let's see. So when we talk about this specific formula sheet, so you have got this MM2 formula, and the formula of this MM2 is basically, if you look at this specific formula, it's actually KE is equivalent to KE 1 plus T KE, etc. etc. Now, what exactly do we mean by this? So one of them is basically, if we have to calculate the APV, one of the formula is the MM2, which you could use. And through this MM2, you could actually calculate the ungeared cost of equity. You could calculate the ungeared cost of equity of the entity. You could calculate what? Ungeared cost of equity. Now, what is the next situation? The next situation is you could use the CAPM, which is the capital asset pricing model. And the capital asset pricing model's formula is the cost of equity is risk-free rate of return plus the equity beta multiplied by RM minus RF. Now, I'm going to demonstrate to you that how are these formulas going to be applicable for the computation of the APV. Now let's discuss. When we talk about this capital asset pricing model, so the one thing in the capital asset pricing model is basically this RF is the risk-free rate of return. RF is the risk-free rate of return. The equity beta, this PE is the equity beta, and this equity beta is actually risk coefficient. This equity beta is actually risk coefficient. Then you have got RM, which is the market rate of return. RM is actually the market rate of return. And when we talk about RM minus RF, this is actually considered to be risk premium. When we talk about RM minus RF, this is actually considered to be market risk premium. Now, So as I mentioned that the equity beta is actually the risk coefficient. So there are actually three types of betas that are available. Now what are those three types of beta? So the three types of beta are actually asset beta, debt beta, and the third one of them is the equity beta. Now what is the difference between this asset beta, debt beta, and the equity beta? So asset beta gives you business risk. The debt beta gives you financial risk, and the equity beta includes both. The equity beta includes both what? The financial risk plus the business risk. It includes both the financial risk plus the business risk. Now let's discuss. The debt beta is considered to have a value of zero because generally speaking, the risk associated with the debt is considered to be negligible. So generally speaking, the debt beta is considered to be zero. So the asset beta and the equity beta are connected through a formula. And what is that formula through which they are connected? This is the formula through which they are connected. I'm going to copy this formula and I'm going to discuss this formula. Okay, now see. So the formula is actually like this, where you have got this asset beta. This asset beta is equivalent to value of equity divided by value of equity plus value of debt multiplied by 1 minus t multiplied by equity beta plus this value of debt multiplied by 1 minus t divided by value of equity plus value of debt multiplied by 1 minus t and debt beta. Now let's talk. So when we assume that the debt beta has a value of 0, so basically this whole bracket becomes a 0 value. And we are left with this formula: asset beta is equivalent to market value of equity divided by market value of equity plus market value of debt 1 minus t multiplied by equity beta. So generally what happens is when we talk about the APV, the first thing that we did was we said that the APV requires you to calculate the base case NPV. And what is this base case NPV? Base case NPV is the NPV calculated on the assumption that the entity is 100% equity funded. So I mentioned that how would you actually go about it? So there are two ways of doing it. One of them is a CAPM way and the other one of them is MM2 way. So I'm discussing the CAPM way. So I discussed that the equity beta, there are three types of beta: asset beta, debt beta, and the equity beta. Now, if the company is 100% equity funded, if the company is 100% equity funded, then the asset beta is going to be this equity means 1 divided by 1 plus 0 into 1 minus whatsoever, let's say 30%, multiply by whatsoever that you do. Um, so resultingly what would happen is the equity beta of this type of a company would be equivalent to the asset beta. So if a company which is 100% equity funded, so its equity beta would be equivalent to its asset beta. Resultingly, what we are going to do is that in order to calculate the base case NPV, we are going to discount the cash flows with the cost of equity, which is calculated using the asset beta. So if you need to calculate the APV, for the calculation of the APV, the base case NPV is discounted using KE, which is calculated using the asset beta. So for basically the formula becomes KE is equivalent to risk-free rate of return plus the asset beta multiplied by RM minus RF. So that is one way of using this. The second approach is to use the formula of MM2. Now what exactly is the formula of MM2? So if I talk about the formula of MM2, the formula of MM2 is actually like this. The formula of MM2 is like this, where you have this is a geared cost of equity and this is ungeared cost of equity. And the other thing is this is market value of debt and this is the market value of equity. Now, what we are going to do now first is that before we go on calculating the entire adjusted present value, the first step that I would want to go about is the calculation of the base case NPV. And then I'm going to explain to you people how the present value of financing side effects come into play. So the first step is the base case NPV. Now let's discuss, let's talk. Kindly go through this question, then we will discuss. So just go through this question, please, and then we shall discuss. Okay, let's start discussing. It says you have recently commenced working for Bureau Company. You have recently commenced working for Bureau Company, and and you are reviewing a 4-year project which the company is considering for investment. The project is in a business activity which is very different from Bureau Company's current line of business. Somebody was asking me a question that how do we decide if we have to use APV or we have to use NPV? So it might actually be mentioned in the question requirement, or at times what happens is when you go into another business, so your business risk changes. APV is also relevant in that scenario also. Now next situation is, it says the following NPV estimate has been made for the project. Now what are those NPV estimates? It says number one of them is basically all figures are in dollar million, time period 0, 1, 2, 3, 4. Sale revenue is given, direct project cost is given, the interest has been deducted. We know that the interest is an irrelevant cost. It's not deducted when you perform the calculation for the NPV. You don't deduct interest. The profit is there. The tax of 20% is imposed. The investment or sale is mentioned here. The cash flows are there, discount factor. It says the NPV is negative 1.65, and therefore the recommendation is that the project should not be accepted. Now, what exactly are the notes to the NPV appraisal project? Let's see. It says in calculating the NPV, the following notes were made. Since the real cost of capital is used to discount cash flows, neither the sales revenue nor the direct project costs have been inflated. It is estimated that the inflation applicable to sales is 8% per year and to the direct project cost is 4% per year. Now let's try to understand one thing. If the exam would have mentioned the same rate of inflation, let's say 4% would have been applicable for all of them, then it would have been okay to use the real cost of capital and the real cash flows. Because the problem is that the rate of inflation is different. I'm repeating it again. The rate of inflation is different. So resultingly, what is actually going to happen is, if the rates of the inflation are different, then resultingly what is actually going to happen is that you can't use the real cash flows, you have to use the nominal cash flow. So that is also one of the mistake that is done. So we'll have to use nominal cash flow. The next, it says the project will require an initial investment of 38 million. Of this, 16 relates to plant and machinery, which is expected to be sold for 4 after taking any taxation and inflation impact into account. So that means this is correctly mentioned here. Now it says tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year thereafter on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. Bureau pays 20% tax on its annual taxable profit. No tax allowable depreciation is available on the remaining investment assets, and they have nil value at the end of the project. So basically, the depreciation hasn't been accounted for, so the depreciation also needs to be accounted for in this specific scenario. It says Bureau either uses either a nominal cost of capital of 11% or a real of 7%. So nominal needs to be used. And general inflation is 4%. It says interest is based on Bureau's normal rate of 150 basis points over 10-year government yield curve. So yield curve plus 1.5% is your interest cost. Now what next is there? It says at the beginning of each year. I'm repeating it again. It says at the beginning of each year, Bureau company will need to provide working capital of 20% of the anticipated sales revenue for the year. Any remaining will be released at the end of the project. So they haven't even considered the working capital in their calculation. They haven't considered the working capital in their calculation. It says working capital and depreciation have not been taken into account in the NPV calculation above, since depreciation is not a cash flow and all the working capital is returned at the end of the project. So they have not considered that. Lastly, it says it is anticipated that the project will be funded by debt. So there are something with respect to financing, but we would read it again. It says the project will be financed entirely by a debt, 60% of which will be obtained from subsidized loan scheme run by government. Issue costs are going to be this. Remaining 40% funds will be from the Burung's normal borrowing sources. It says Burung has identified a company which is Lintu company, which operates in the same line of business as that of the project. It is considering Lintu is financed by 40 million shares trading at 3.2, 34 million debt trading at 94. Lintu's equity beta is 1.5. Current yield curve is 2, and it is estimated market risk premium is 8%. The tax is 20%. Both Burung and Lintu pay tax in the same year when the profits are earned. Now, it's a 15 mark requirement, and you need to handle it tactfully. How would you handle it tactfully? So in order to handle it tactfully, the approach that you should adopt is you should you should actually go one by one. Now, one of the marks that are there in this question is to calculate the NPV with corrections. The other is to calculate the relevant discount rate. So we get the base case NPV. We get the base case NPV. Then the third situation is we get the base case NPV. Then the third situation is basically we need to use the financing side effects. So these are the three things that actually need to be rectified. So it is suggested in the exam that you handle each one of them one by one. The first thing that I'm actually going to do is that I'm going to calculate the discount rate. So in order to calculate the discount rate, let's talk. First of all, you need to calculate the asset beta of Lintu. So in order to calculate the asset beta, the formula is equity beta multiplied by market value of equity divided by market value of equity plus market value of debt 1 minus t. So if I talk about it, the first one of them is basically the market value of equity is going to be calculated like this. You have 40 million shares and each share is trading at 3.2. Each share is trading at 3.2. For the market value of the debt, the calculation is going to be 34 million of debt. Each bond is trading at 94%. So each $100 bond is trading at 94. Resultingly, you would have the market value of debt. Now, the equity beta is basically what? 1.5. The equity beta is what? 1.5. So we need to calculate the asset beta in total. So how much does it turn out to be? Can somebody please confirm? Okay, so the asset beta is 1.25. The relevant cost of equity is going to be, you have the risk-free rate of return, which is 2%, plus 1.25 multiplied by the market risk premium is given to us. and it is actually 8%. It is actually 8%. So how much is the overall KE? It's 12%. So this is the KE to be used. Okay. Now, so one of the aspect is done, which is the relevant discount rate is calculated, in which we have incorporated we have assumed that the entity is 100% equity funded. Now we need to rectify the calculations of the NPV. We need to rectify the calculations of the NPV. So what I'm actually going to do is that in order to make things easy, I would switch to the Excel mode because so that we could have a quick calculation, because at times I do get stuck in order to wait for the answers from you people. So what I'm actually going to do is I'm going to use the Excel so that I can solve this in a better manner. Okay, so what we actually need to do is that we need to calculate the corrected cash flows, because once we have the corrected cash flows, then the things are going to become easy for us. Okay, let's actually discuss. So we have got sales. We have got sales, and then what we have is we have direct project costs. We have sales, and then we have got this direct project cost. And what else do we have? We have the interest needs to be eliminated. So basically time period 0, 1, 2, 3 and 4. Okay, so the selling price is subject to an inflation of 8%. The sales in the year 1 are expected to be 23.03. You need to multiply this with 1.08. And the sales here in the year 2 are expected to be 36.06. And what we need to do is that we need to multiply them with 1.08 power 2, because there is actually going to be a compounding effect of the inflation that would be applied to the cash flows. Then if I move forward, so there is actually going to be this 49.07 multiplied by 1.08 power 3. And lastly, you have got 27.14, and it's going to be multiplied with 1.08 power 4. So this is what you have got. You've got the sales for time period 1, 2, 3, and 4. Now let's discuss about the direct project costs. We are being told that the direct project costs are basically growing by 2%, by growing by 4%. So it's actually going to be 13.82 multiplied by 1.04. That is what it is going to be for the time period 1. For the time period 2, it is going to be 21.96 multiplied by 1.04 power 2. The third one of them is going to be 29.44 multiplied by 1.08 power 3. And the fourth is going to be 16.28 multiplied by 1.04 power 4. So this is what we have as a direct project cost. Now what next is there? We are expected to have depreciation. So we need to incorporate the concept of depreciation here. The depreciation in the first year is expected to be 50% of the cost of the asset, which is the plant and machinery. So it's going to be 16 into 0.5. Next situation is if it is going to be 16 into 0.5 followed by 25% per year thereafter. So it is actually going to be the remaining net book value is 8 million multiplied by 0.25 is what it is going to be, and then multiplied by 0.75 of this. And lastly, the depreciation for the final year is going to be, we need to consider the gain and loss on disposal, or I'm just going to consider that what is going to be the depreciation in the final year. It is going to be multiplied by 0.75. So these are the depreciation. So then you have the taxable profits. You have the taxable profits. The taxable profits are this minus this and minus this. So we have the taxable profits for the various time period. Then you have got tax at the rate of, what is the tax rate? The tax is at the rate of 20%. So this is actually going to be this multiplied by 0.2. So this is what the tax is going to be. Then you have got the depreciation, which needs to be added back because it's a non-cash item. So the depreciation needs to be added back because it's a non-cash item. Then what happens is we have got the working capital. Now, what is the examiner told us? The examiner has told us that the working capital requirement is going to be 20% of the anticipated sales. I'm going to tell you people that how do we go about with the working capital requirement. It's basically, this is the time period, this is the sales, this is the working capital, and this is the incremental effect on the working capital. So this is time period 1, 2, 3, and 4. The sales are expected to be this. The sales are expected to be this. And the sales are expected to be this. And the sales are expected to be this for the various time period. The working capital requirement is expected to be 20% of the sale. So the incremental is this. This is what we do is that we believe that this amount of working capital is already invested. Okay, thank you, Karan. I'm just gonna, okay, yes, I've made a mistake here. It should have been 4%. It should not have been 8%, right? Anyways, so the working capital that you need to do is that the requirement of year zero's working capital, year one's working capital would be input at time period 0. Then what happens is this is going to be here, then it is going to be here, and then lastly what is going to happen is, and at the end of the day everything is going to be recovered. So this is how the working capital requirements would go about. This is how the working capital requirements would go about. Okay, so once we have working capital, then there is this investment. So the investment is going to be what? The investment is going to be 38, and at the end there is going to be a residual value of 4. Okay, so then what we have is we have the cash flows. I hope that I'm not missing out anything, and I hope that I'm clear to everybody. Okay, Karan, I've rectified it. The discount factor at 12%. The discount factor is 12%. So if I say 12%, let's see. Okay, so we have got the base case NPV, which is actually going to be this 8.296. Okay, is it okay to everybody? Okay, thank you. Now let's move forward. So the first step that we had was to calculate the base case NPV, and we have done that. So the base case NPV is 8.296 million. It's 8.296 million. Now let's move forward. Morally, if there is actually going to be a loss after deducting the depreciation, then such loss needs to be carried forward. Such loss needs to be carried forward. Okay, let's discuss. Well, it depends. You can either carry it forward, or you could actually have an alternate way, which is that there could be an assumption that the entity has sufficient profits elsewhere to claim these losses. So that could also be done. The theme for sure I will discuss. Don't worry about that. Okay, now let's discuss. The next situation is the concept of present value of financing side effects. What we have done up till now is that we have assumed that the project is 100% equity funded, but we do know that this is not how it is. We do know that this is not how it is. So what are we going to do now? So the present value of financing side effect, the concept of this present value of financing side effect is that whatever way that you're going to finance the project, you need to actually you need to actually you need to incorporate the relevant cost. You need to actually incorporate the cost of financing. Now there are various aspects. The number one of them is called the issue cost. So when we obtain loan, when we issue shares, there are generally some issue costs that you need to bear. I am repeating it again. When we obtain some loan or when we issue some shares, there are generally the issue costs that we bear. So when we talk about the issue costs that we bear, Yasmin, just wait for a while. I'm gonna come back to you. So when we talk about these issue costs, so generally speaking, what happens is the issue cost on loan, or you could say the debt, are tax deductible, and the issue cost on the equity instrument are not tax deductible. Are not tax deductible. Now, so what are we gonna do? We're gonna say that if the issue costs on the loan are tax deductible and the issue costs on the equity are not tax deductible, so generally speaking, what you need to do is that you need to understand that how much is the issue cost. So whatever the issue cost, that is shown as an outflow, and whatever the tax savings that you get on the issue cost, that's shown as an inflow. So you get the net issue cost. So that is one of the aspects. That is one of the aspects. Now, let's talk about the other one, which is actually the tax savings due to interest. So assume that if you have taken a loan, which is, let's say, 10%, $100,000 loan for a period of 4 years, assume that. What is actually going to happen is the tax rate prevalent is assumed that 20%. So what would happen is you would have interest expense from year 1 till year 4 of this 10,000, and the tax savings at the rate of 20% would turn out to be 2,000. The discount factor from year 1 till year 4 would be used, Now the question mark that arises is what is the discount rate that we are going to use. So there could actually be two discount rates. Either you could use KD or you could use RF. I'm repeating it again. Either you could use KD or you can use RF. Now when we use KD, what is our assumption? Our assumption is that we when we use KD, our assumption is that since the debt has a tax rate of 10%, so the relevant discount rate is also 10%. And when we use RF, let's say 2%, so our assumption is since the government is providing the tax saving, therefore the government's rate is to be used. So the government rate is to be used. Okay, now what next is there? The third one of them is basically in case if we have got subsidized loans. I'm repeating it again. In case if we have got subsidized loans. So what happens with these subsidized loans is that when we have these subsidized loans, so what happens with these subsidized loans is that the market interest rate may be 10% and you would have gotten a loan at let's say 6%. So there is actually a 4% interest saved. So what we generally do is that we say that the interest saved and then extra tax on it. So resultingly, that's the net interest saved. Resultingly, that's the net interest saved, and we discount them accordingly. Lastly, the fourth one of them is basically spare debt capacity. Now, what do you mean by spare debt capacity? At times, what happens is due to undertaking a project, your debt capacity increases. Now, what is this debt capacity? This is the ability to borrow. So the debt capacity is your ability to borrow. So when we say that our debt capacity increases, so this actually means, what does it actually mean? It actually means that our ability to borrow has actually enhanced. Now, resultingly, what is actually going to happen? Resultingly, whatever the amount of extra tax saving that we could get because of that debt, we would incorporate that. So I've discussed with you that what are the financing side effects. So basically, if we talk about the calculation of APV, how do we calculate the APV? It's the base case NPV. It's the base case NPV and then present value of financing side effects. And then the present value of financing side effects one by one, we incorporate that. So it could actually be issue cost. It could actually be the tax saving due to interest, subsidized loan, etc., etc., etc. Is it okay to everybody? Is everybody okay with these? Okay, now what I would want you people is that you should try to attempt this question and try to calculate the financing side effects of this question. Try to calculate the financing side effects of this question. Calculate financing side effects of this question. You can take 5 minutes and you can calculate financing side effects. Okay, so we are gonna commence in just 5 more minutes. We'll continue with this question in 5 minutes time. Okay, now see. So if in this question we are actually going to talk about that how would the financing side effects be incorporated? Okay, it says it's anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government. So the entire project would be financed by debt, 60% from the subsidized scheme. So how much is the amount of finance that is actually needed? So it's 38 million which is needed. So of the 38 million, 60%, how much is the 60% amount? Will be financed by the subsidized loan, and that subsidized loan scheme run by government which lends money at a rate of 100 basis points below the 10-year government debt yield rate of 2.5%. So what it does is that uh, so this is actually going to be at 1.5%. 100 basis points below the 10-year government debt yield rate. Issue costs related to the finance are 2% of the gross finance required. So issue costs are going to be 2% of it. The remaining 40% will be borrowed from the normal borrowing sources. And what is the normal rate of interest that we pay? So we are being told in the question that the normal rate of interest that we actually pay is 150 basis point above, which is 2.5% plus 1.5%, which is 4%. So the normal is 4%. Now, so first thing is, let's talk about the issue cost. So we have not been given anything that what is the status of the issue cost, if it is tax deductible or not. So we could take an assumption that the issue cost would be tax deductible. So 38 million. So it is actually going to be 38 million multiplied by 2%, which is the issue cost. So how much does it turn out to be? How much does it turn out to be? Okay, 0.76 million. I'm saying that there's going to be a tax saving at the rate of 20%, the relevant tax rate. So if it is going to be there, then how much is the tax saving? Okay, 0.152. And what is the net amount? 0.608. Okay, now what else is there? So this is actually the issue cost. Then the second one of them is basically the tax savings due to interest. So one of them is a normal loan. The loan is 38 million multiplied by 40% multiplied by 4%. How much is the interest there? Interest. Can somebody please? Okay, interest is again 0.608. Okay. So the tax saving due to interest is actually going to be, this is the interest. The tax savings on it at the rate of 20% turns out to be how much? Okay, 0.1216, 0.1216. So if this is actually going to be 0.1216, then what else is there? So basically what we would do is that the discount factor year 1 till 4, the annuity factor at the rate of how much percent, you should use the relevant KD. So that is actually going to be 4%. Well, there are two things. You can either use RF or you can either use the relevant KD. So the KD is used on the assumption that this loan is subject to this rate. So the tax saving would be subject to this XYZ rate. Yes, you can do it. But the point is, I'm not calculating the net amount. I'm just saying the tax saving due to interest. I'm not considering the interest. I'm just saying the tax saving due to interest. Yes, recommended is KD. Okay, can somebody please confirm what's the annuity factor of 4% for the 4 years? Okay, so it's actually going to be 0.1216 into 3.63. How much is it? Okay, so this is 0.4414. Now, similarly, on subsidized loan, it's 38 million multiplied by 60% multiply by. It's 38 million multiplied by 60% multiply by 1.5%. How much is it? Okay, 0.342. And what is the tax saving on this interest? 0.0684. Now, say 4-year annuity factor at the rate of 1.5%. How much is it? What's the 4-year annuity factor at 1.5%? 3.854. Okay, so how much is it overall? 0.2636. Okay, 0.2636. Now, so what have we done up till now? We have calculated the tax saving due to interest on the normal rate loan and on the subsidized rate loan. The third thing is basically the interest saved due to subsidized loan. Interest saved due to subsidized loan. So let's talk about it. We would have normally borrowed at 4%, but now we have borrowed at 1.5%. Multiplied by 38 million, multiplied by 60%. So how much does it turn out to be? 0.57. The same discount factor at the rate of 1.5%, the 4-year annuity factor. So what is actually going to happen is 3.854. How much? 3.854. So how much does it turn out to be? Okay, 2.1967. Now, so if we talk about the APV calculation for this scenario, the APV calculation is going to be base case NPV, which is 8.29, 8.296. The base case NPV is 8.296 million. That's what the base case NPV is. And then you add the present value of financing side effects. The present value of financing side effects. So basically, when we talk about the present value of financing side effects, the first thing is that the net issue cost, and then tax savings due to interest, and then lastly, net interest saved due to subsidized loans. So what was the net issue cost in total? Zero point 608 is the net issue cost. What is the tax saving due to interest? Please uh, tell about both the loans. One of them is 0.4414, one of them is 0.2636. Okay, so how much is the total? And then there is this net interest saved due to this 2.1967. So resultingly we have the APV, which turns out to be 10.590 approximately. Okay, so is everybody okay with this? Okay, there is somebody who's asking a question that what do you do with the gross part which they have mentioned? Uh, Problem with the gross part they have mentioned in the question about the issue cost of the, well, when it says the issue cost of the gross finance required, that means whatever the total finance that's needed for the business, that is going to be the issue cost is going to be applicable on that. That means at times usually what happens is that we come across situations where we are being told that the loan from the government is not subject to issue cost. So here basically when it says gross finance required, that means even the loan from the government would be subject to the issue cost. Okay, so we are actually done with this specific question, and I can actually, I mean, the formula that we use in this specific situation for the APV was the capital asset pricing model, but you could come across a situation where you're not given the betas or things like that. So in that circumstances, what you would do is that you would use this formula of Modigliani and Miller. So basically, the KE ungeared needs to be calculated from the formula if you come across such a thing in the future. Well, nothing is must in the exam, Osman Shahzad. It can come, it cannot come. I mean, you can't actually predict, and I'm not in a mood to predict anything at all. Um, so, anyway, so we are done with this question. The second requirement of the question was it says that comment on the corrections made to the original NPV calculations, present value estimate, explain the APV adjustment, etc. etc. Now, what I'm actually going to do now is that I'm going to use this some time that is left for the session. So I'm actually going to guide you people that how could you go about for the preparation of the exams and what are the areas that you must actually practice. I shall inshallah be sharing out one of the list for the important questions to practice. Also, I'm going to share that probably on the Facebook and on the WhatsApp group. But I'm just going to guide you people a bit about how you could actually speed up your calculations. My suggested approach is going to be, first of all, you do the basic WAC, in fact, the complete WAC. You do the investment appraisal concepts, and then you do this mergers and acquisition basic concepts, and then the restructuring and the reconstruction basic concept. This is the first thing that you should do. The best way to prepare for these areas is that you prepare them and then you try to attempt the questions between question 2 to 4. Ideally speaking, you should attempt at least 2 questions for each area. So ideally that makes it 4 areas, so that makes it 8 questions. And then what you should do is that you should attempt, once you have done this, then you should attempt question number 1, at least 6 questions from the past papers. Because usually what happens is the past paper questions, which are there with these 4 areas, which is the WAC, investment appraisal, merger acquisition, restructuring. These questions usually have uh, these 4 topics which are tested in tandem. They are tested together. I mean, you would come across questions where these topics would be tested together with each other, so you don't have much of a segregation. It's completely integrated testing that is done. So you could actually prepare these topics first, then you could actually prepare at least 2 questions from each topic from the section B of the exams, and then you attempt at least 6 questions of question 1, and ideally all of them should be the latest questions. Now, the next step is basically the risk management. So, the good thing to do about the risk management is there are comprehensive questions for the currency risk, and there are comprehensive risk questions for the interest rate risk. So, at least 2 questions from section B for each, and then you should try to do at least 3 questions from section A. If you get through these areas, that means you would be done with around 75% preparation for the exams. Now, what's the next thing? Ideally speaking, all the theory parts of the questions, what you should do is that there are 2 types of theories that are tested. One of them is a connected theory, which is to connect it to the exam question, and the other theory is basically a theory which is generally a bookish knowledge. So what you should do is that you should go through maximum exam question. You should read through the answers of the question and get hold of the various theoretical aspects that are discussed. And for the connected theories, just see that how they are connecting the computations with the theoretical aspects, so that you can get a good idea that how is this actually all making sense. So, and lastly, one thing that you could do is that you could access to latest last 3 years examiners articles, which are there on the ACCA website. So if you access last 3 years articles, it would actually be very fruitful, very beneficial for you. So I think that don't actually set yourself very optimistic targets. Just try to stay within the limits. Don't actually bother for small areas of the syllabus. Just focus on the major concept. And even if you come into the exam and you come across a situation where the question becomes very tough, just try to split the question into parts. Just try to attempt the smallest part of the question, which could be like in this APV, we attempted the question. It could have been just the correction of the cash flows. It could have been just the calculation of the WAC. Because once you start attempting even a smallest part of the question, then the things start to move in your direction. Then the things they start to move in your direction, and you actually slowly, gradually move forward. Okay, so I think this is enough. Anybody wants to know any question? Anybody wants to ask anything? Okay, alias and R for the report structure, it's quite simple. Uh, you just need to understand there are two things, three things with respect to the report, and that are actually number one of them is you should actually have the initial thing, which is to, from, at the same time date and subject. You'll get 1 mark for doing this. Then you should actually give an introduction section, and what you need to do is that you just need to reword the question requirement. You just need to reword the question requirement uh, in this introduction para. You get 1 mark for that. Then lastly, you go for the conclusion. You get 1 mark for that also. And for the conclusion, you just need to simplify. You just need to summarize. That's it. So these are the 3 marks that you should ideally go for the remaining body of the report. It's very much question mark. Okay. Ali S and R, Tasneem, how the section A must be attempted. Okay, now there is a question that how should we attempt the paper? Should we attempt a question from section B or should we attempt a question from section A? So my suggestion is going to be you should attempt first section A because it's a 50-mark question and that's a maximum mark. But ideally speaking, you should focus more on the theoretical aspects of the question because one of those part which is connected to the calculations that you perform, even if you get the calculations wrong and you refer the wrong calculation correctly in the theory, you'll still get marks. Also, the next situation is this is one thing is done. The next situation is attempt. I mean, don't waste time. Don't waste a lot of time on the question. If you don't know anything, just skip that part. Just move forward because you should try to invest more time onto the things that you should know. I mean, it's good. It's always good to attempt the complete paper, but it's not worthwhile investing or wasting time onto the things which you actually don't know at all. Alias and R, you can start with appendix. That's fine. I mean, usually there are 4 marks available for the report, and you can easily get 2 marks. And I think the remaining 2 marks you should not go for. That's what you should do. Yasmin, I would recommend. Don't worry, I would share those on Facebook and on WhatsApp. Osman Shada, there is no session tomorrow. It's the final session today. You could listen to the earlier sessions by logging on to vimeo.com. Okay, so I would really appreciate if you people could share your feedback, overall feedback for the session, the total of 4 days that we have had together. If you could share the feedback, so that is actually going to help a lot to me and to the ACCA team also. And we would highly appreciate if you could share your feedback, please. Mohammed Hamid, yes. Thank you, Shelly Devi. Would also appreciate if you could have a complete feedback over the entire webinar session, please. I would appreciate others to also please comment, as your feedback, your comments are important for us. Tasneem, you see, that is what makes a paper challenging. Um, so every question could be different. It is, but the point is you should know the basic concepts right, and then you can handle all types of question. And the more and more practice that you do in a proper manner, that would help you clarify the concept. Thank you, Kushal. Thank you very much. Thank you, Nabil Anjum. Jasmine, thank you. Shelly Devi, that's so nice of you. Thank you very much for a complete review of the overall session. Smita, thank you very much. Ali Asandar, yes, I could understand that when I started off with this foreign exchange, I started off assuming that people know it very well, but unfortunately it wasn't like that. But thank God that you people stopped me, and I actually um, actually went the way it actually was fruitful for all of them. Tasneem, thank you very much for a very comprehensive response. May Allah bless you also. Yeah, Tasneem, please share. Would be very helpful. Pallavi, thank you very much, Pallavi Mittal. Baita, I think I am unable to. I'm unable to pronounce your name correctly, but um, um, you can get the handouts. I'm gonna share them on the WhatsApp link. Don't worry about that. Mary Claire, don't worry. It's all recorded, and you can get access to it on the website. Yasmin, for free real calculation interest rate on something we don't do it net of tax. For the subsidized loan, yes, we do net of tax. I mean, you see, for the subsidized loan, we do two things. One of them is we calculate the tax saving due to interest, and then second we say net interest saved due to loan. Osman Sajat, highly appreciated. Tasneem, yes, I would do that. Don't worry. Thank you for your feedback. Okay, thank you very much, everybody. Thank you for your time. Thank you for attending these sessions. And I hope and pray that all of you would, inshallah, score a pass in this AFM. For many of you, it might actually be the last paper towards qualification. One thing which is most important is that you should have a passing attitude. And what do we mean by passing attitude? Having a passing attitude actually means that you should you should actually not you should not actually worry with any question in the exam. You should just handle all of them patiently. So if you have a passing attitude, you would do really well. All don't bother about the small things which you may not have covered. They don't really actually leads towards the failure. Thank you, Tasneem. Thank you, everybody. Wish you all the best. Thank you.